I think this video is both right and a little bit addicted to being right. Coin Bureau's core claim is blunt. The corporate Bitcoin Treasury trade has stopped being a bullish flywheel and is turning into a liquidation machine. That is a serious claim, and to the video's credit, it doesn't just wave at vibes. It tries to build a mechanism, premium-to-NAV, equity issuance, debt, Bitcoin accumulation, then the whole thing running in reverse once that premium breaks. The problem is that the video sells a diagnosis of fragility as if it has already proved a catastrophe. Those are not the same thing. The strongest part arrives early, around the flywheel explanation. This is where the video actually does analytical work. It says these treasury companies only look magical while the stock trades above the value of the Bitcoin it holds, because that premium lets management issue expensive paper, buy more Bitcoin, and report a bigger treasury that investors then reprice with the same optimism. That is a real reflexive structure. And the slide spelling out the 1.0x line matters, because below that line the whole story changes from self-funding accumulation to dilution without obvious benefit. That is the cleanest, most useful thing in the video. But then the video starts quietly cheating with its own framing. It moves from "this model depends on a premium" to "the floor under Bitcoin is fragile because these firms may become forced sellers." Maybe. But the evidence shown here does more to prove that equity-funded treasury companies are vulnerable to valuation compression than that a broad market doom loop is imminent. Those are different scales of claim. A company can be in trouble without becoming the reason Bitcoin breaks. The narration wants the second one because it's scarier. The MNAV section is another case of the video being sharp and slippery at the same time. As a shorthand for market enthusiasm, MNAV is useful. If a treasury company trades at a physically imposing premium to the value of its coins, that premium is basically investor permission for management to keep feeding the machine. Fine. But the video treats MNAV almost like a sovereign risk gauge, as if crossing some threshold automatically flips a stable structure into insolvency theater. It doesn't. MNAV tells you something about equity market appetite and optionality. It does not, by itself, tell you the exact debt tolerance, liquidity runway, covenant flexibility, or management behavior under stress. That missing layer matters because the whole alarm bell in this piece depends on turning a valuation metric into a liquidation forecast. The debt discussion is where I most wanted the video to slow down and become boring, because boring is where the truth usually lives. We get the headline version. Strategy has roughly $1.7 billion of debt. Unrealized losses are huge, and if Bitcoin falls hard enough, the company could be pressured into unflattering decisions. That is a legitimate concern. What the video doesn't really do is separate debt maturity, coupon burden, convert structure, collateral constraints, and management's ability to keep raising capital even in a damaged stock. In other words, it proves vulnerability, not timing. And in a market like this, timing is half the argument. Still, the reverse flywheel section is genuinely good. This is where the video stops sounding like generic crypto panic content and starts sounding like capital markets analysis. If the premium compresses, issuing stock becomes less attractive. If the stock weakens while Bitcoin weakens, the narrative that justified leverage weakens too. If creditors or shareholders stop believing the treasury model creates value, management loses the elegant financing route that made the whole thing feel self-reinforcing. That is the warning worth taking seriously. Not because it guarantees a cascade, but because it reveals how much of the bullish case was financial engineering wearing a Bitcoin costume. Now for the missing counterweight, because the video is selective in a way that flatters its thesis. It spends a lot of time on what happens if Bitcoin falls towards 60,000 and treasury names trade below NAV, but much less on why investors have tolerated these structures in the first place. Liquidity, proxy exposure, convert optionality, index inclusion, and plain old belief that management can keep arbitraging public market enthusiasm for longer than skeptics expect. You can think that belief is reckless. I often do. But if you leave it out, you turn a contested market structure into a morality play where only gravity gets a vote. And this is where the presentation actually affects the substance. The Reuters screenshot, the SEC filing text, the Bloomberg-ish visual grammar of the thing. All of that gives the argument an institutional smell that is stronger than the evidentiary base we're actually shown. I don't mean that as a cheap shot. The sources themselves are legitimate anchors. The issue is proportion. The video uses the aesthetics of documentation to make a probabilistic scenario feel almost administrative, as if the collapse has already been processed and stamped. It hasn't. The evidence does less work than the narration suggests, and the edit helps hide that gap. Underneath all the Bitcoin talk, this video is really about a more uncomfortable idea. What happens when a public company's identity stops being its business and becomes its financing loop? On that level, I think Coin Bureau is onto something important. Treasury companies can create the illusion of permanent demand and permanent conviction when what they may really be creating is permanent sensitivity to market structure. That's the smart read. The overreach is turning that structural sensitivity into a clean prediction of market disaster rather than a contingent risk map. So my verdict is, this is a strong explainer with a loaded ending. It earns real credit for making the Treasury flywheel legible, for treating premium-to-NAV as more than a meme, and for showing why leverage plus identity plus falling prices can become a nasty combination. But it also overstates how much it has proved. It has not shown that a corporate treasury unwind is the next major driver of Bitcoin's collapse. It has shown that one class of Bitcoin-adjacent public companies may be much more brittle than their evangelists admit. That's still worth your time. It's just a narrower, less cinematic truth than the title wants. And if you like reviews that don't just ask whether a market video sounds smart, but whether the balance sheet logic actually survives contact with daylight, stay close. The next time a creator turns a financing structure into an apocalypse trailer, I want to catch the exact frame where the argument stops proving and starts performing.